everyone. Very nice to have you join us again. I appreciate those of you joining us for the live version of our webinar with Austin Fitch of Horizon Investments. As I wrote in the email that you received inviting you to today's video conference, we were interested in having a video conference. When I say we, I mean you as the client, I as the advisor. Austin was good enough to jump right in and say, of course, we'll do that for you this week, Lou. So we always appreciate that. Austin is the Managing Director of Consulting Solutions at Horizon Investments. As part of our compliance portion of the discussion today, I do have to read our disclosure, which today is Friday, May 13th, 2022. And the webinar, it was created in May of 2022 and is provided by Horizon Investments, LLC and Tranquilli Financial Advisor, LLC for educational use only. The opinions expressed herein are of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon reserves the right to modify its current investment strategies along with Tranquilli Financial Advisor and the techniques based on changing market dynamics or a specific client need. There is no guarantee that their assessment of the investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goal and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee against loss or declines in the value of a portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when risk assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have the risk assist feature. While risk assist was designed with the goal of limiting drawdown, also known as loss, Horizon is not able to predict all market conditions and ensure that risk assist will always limit drawdown as designed. Accounts with risk assist are not fully protected against all losses. And thank you, Austin, for providing the disclosure for that. So welcome again to everyone that's joining us in the live version of this. Austin Fitch, welcome again to Tranquilli Financial Advisor Conversation with Our Clients. I would like to share with everyone what my goal for today's meeting is, to try to make this approximately 30 minutes of conversation between Austin and I, to give you, I'll say, what you've requested as part of your correspondence with me over the course of the week when I sent out the email letting clients know, Austin, that we were having not only this meeting and with other investment firms that Tranquilli Financial Advisor works with have reached their stop loss limit, and that was going to be triggered. So my goal for today is to keep it around 30 minutes, get into some information of how we got here, Austin, how long will we be here, where are we going from here, and then talk a little bit about bonds, which I think works well into the risk assist conversation. So welcome back. Good to have you again with us. Austin Fitch, go ahead and take it away, and let's start with that. How did we get here part of the conversation?
Yeah, no, Lou, really appreciate you having me back, and really appreciate everything you do for your clients, and the fact that we have such I think, a good partnership between the two firms. Excited to be with everybody today. Lou, I think the questions that you've outlined, it's going to give us a lot to go through. But to your point, I think kicking it off with how did we get here makes a lot of sense. Because as everybody knows, what we've gone through, both from a market standpoint, but also from just a day-to-day standpoint over the last 2 years, has been nothing short of, I would say, interesting to say the least. And obviously coming out of COVID over the last, call it, 6, 12, 18 months at this point, has created a unique environment, not just for the market, but for the global economy as well. And that's really led us to kind of where we are today. I would tell you, and I think we may even have mentioned this in the past, is when COVID happened a little over 2 years ago now, and the outbreak began in March of 2020, really what you saw was kind of this shuttering of the global economy. And it happened almost overnight. It was like a light switch, right? The global economy went from 100% to 25% operating capacity, literally in the course of less than 2 weeks. I think what we found is that turning the economy back on is not a light switch. It is much more like a dimmer switch, and that you have to slide it up. And it's also what we're seeing is it's happening in fits and starts. And what that means is, from a market standpoint, has created periods of volatility and some volatility, obviously a little bit more here recently, that has come off the back of a few different things. Obviously, we started to see and truly experience some of these supply chain issues late last year, right? The idea is that, there were ships stuck in ports in California that, there were 30, 40, 50 ships just literally waiting out in the ocean to be unloaded, that there wasn't the labor, or, there wasn't there weren't the trucks to unload them. There were so many things really preventing kind of a normal flow of goods and services. And that while it has marginally gotten better, it's still nowhere near fixed in terms of that global supply chain. So we've seen that's contributed to this whole inflation conversation. And the inflation conversation is important because if you think about where we sit today, the reason that you're seeing kind of some of the Fed activity that we are seeing, well, I'm sure we'll talk a lot more about kind of the Fed policy that is currently in place. But the Fed activity is really with the goal of trying to dampen down inflation. For those of you that aren't terribly familiar with kind of the Fed's objectives, the Federal Reserve here in the United States, they have two goals, two mandates. One is to keep employment as close to or as near full employment as possible. By definition, that's typically somewhere around kind of a 4% unemployment rate. I would tell you right now, we are at what it qualifies as full employment. So that is not something that is of terrible concern from a Fed perspective. Now, rewind, 12, 18, 24 months, that was at the top of their list, right? Remember, in the depths of COVID, you had so many workers furloughed, laid off, let go, that was the part of the mandate that they were worried about. Today, though, it's the second part of the mandate, and that is keeping inflation at what they call kind of a normal rate. And for that, for that perspective, normal for them is about 2%. And it's not 2% every given day. It's 2% over a longer period of time. But what we've seen over the last, call it 6 to 9 months at this point, is inflation is well above that kind of 2% target, which is obviously dragging, inflation expectations over the longer term higher. And the Fed is really jumping into action from a rate hike perspective. So raising interest rates to try and fight that inflation piece. So that's gotten us to where we are today. I would tell you, Lou, what that means is it's absolutely been a severe headwind on fixed income or bonds, as you mentioned earlier. I know we'll talk a lot about kind of the diversification characteristics, or maybe lack thereof, that we've seen in bonds so far this year. But just to put it in perspective, bonds are down 9.5% as of the end of day yesterday on the year. So that's in 4.5 months at this point. Bonds have actually lost almost 10% of their value. And to put that in perspective, equities year to date are down 17. So bonds are down more than half of what stocks are year to date. Typically, and Lou, this kind of gets at what you're hinting at, that we'll talk about a little bit later. Typically, when stocks are down 17, 18%, you would expect bonds to be flat or potentially positive. That idea of kind of the inverse correlation. The fact that you haven't seen that is really what's led to a lot of the headlines around, this idea of a very difficult market environment for folks to navigate. That's kind of where we sit today. I would tell you a lot of what has happened in terms of the inflation conversation and the subsequent interest rate conversation has then bled over into equities, which has led to some of that volatility in stocks, has caused I would say, concerns to some extent for companies when they're thinking about kind of inflation and the ability or maybe inability to pass that on. So there's definitely been a drag year to date from a market perspective. We have plenty of thoughts in terms of where that goes, but that hopefully puts us in a good spot to kind of set the frame or set the picture of where we are today.
All right. So if I can somewhat summarize, I mean, there's a lot there. We could spend a long time on each one of those topics. We won't, but what we'll do is I'll give you my summary of it in discussions that we've had leading up to this conversation. And for everyone listening, normally through 5 months of the year, I'll have had 2 or 3 conversations with Austin, maybe a few more with other investment firms. I'm well past that in 2022 because of the bond volatility. It's almost a weekly. Let's get on the phone, Austin, and tell me what you're seeing, kind of thing. So if I can summarize, inflation is really reverting to the mean, but it's doing so, lack of a technical word to add to it, in a vicious manner. Meaning, we've spent a decade with effectively 1% inflation per year. You mentioned earlier, Fed's goal is 2%. Well, reversion to the mean says we are going to experience some pain as it applies to inflation in a hurry, and it adding in all of the other pieces, the COVID piece, the stimulus packages, and no negative to any of that, just as it applies to what's going on right now. That means when you're looking at a report of 8.5% inflation, we're reverting to the mean. We're getting back to the average that really should be 2%. Am I wrong about that?
Not at all. I will say the one, I would say, marginal positive, and this is with a lot of things that we're looking at here at Horizon, is the fact that, yes, inflation's at 8.5% right now. We don't see inflation staying there for long periods of time. We see that reversion to the mean, and you talked about it being vicious to the upside. We think there's actually a halfway decent chance that you're back down in close to a normal range, maybe even by the end of the year. So it's that period that we've kind of lived through over the last 6-9 months at this point, where you've seen, to your point, Lou, you've gone from 1 to 2% inflation to 8% very quickly. We do think that starts to roll over, and with the Fed policy that's currently in place, we think that actually exacerbates the fall as we get into the back half of the year. So the fact that inflation has been high is absolutely true. We're just not in the camp that thinks it persists for a really long period of time, i.e. the 1970s.
Okay, well, and again, that's a good thing. All right. I mean, you certainly don't want to see this for an extended period. The other part of that, the interest rates, that again, I know you're covering a lot of ground for us here. So interest rates being pushed upward, short-term interest rate, overnight rates by the Fed, again, put another kind of pressure on the stock market that it reacts. Obviously, it has reacted negatively. We've talked about, you and I, about additional 50 basis point increases. Mm-hmm. And that'll lead to the next question of how long will we be here, and those additional interest rate increases that I will say Horizon did a really nice job of preparing me for the portfolios. How long do we see that going on? Yeah. How long do we stay where we are right now in your estimation?
No, I mean, that's a great segue, Lou, because I think, and this is really interesting, if you look at what kind of the market's expecting and to some extent pricing in, the market was actually pricing in that 50 basis point hike that we got last week. So the Fed raised interest rates, the short-term interest rate that you're talking about, 50 basis points last week. They raised interest rates 25 basis points in March. So far this year, they've raised kind of that baseline interest rate by 75 basis points, so 0.75%. What's kind of crazy to think about is what's in the projected plan, if you will, is another 225 basis points of rate hikes between now and next March. So in the next, let's call it 10 months. And so that's 2.25% further. Just to put that in perspective, that would be 300 basis points of hikes over the course of 12 months. And normally 300 basis points of hikes takes anywhere from 3 to 5 years. And that's also part of the reason that you've seen the volatility that you have is, I would tell you, even as late as last fall, the expectation was the Fed rate hike cycle. So that the amount of time that it would take them to hike interest rates or raise interest rates from 0 to 3%, the belief was that would drag on into 2024. At this point, it looks like the Fed very well may be done by the beginning of 2023. So that shortening of the window by almost 2 full years has really exacerbated some of that volatility. So then, to your point, the question then becomes, well, like, how long do we remain in this period of volatility? I think our view on the Horizon side is that it definitely probably persists through the summer. And the reason I say that is you likely have another 50 basis points of rate hikes in June. You have another 50 basis points of rate hikes in July. Those, to some extent, are probably already in the cards. I won't say they're rubber stamps necessarily, but probably pretty close in terms of what the Fed's expecting to do. It's going to be really hard for them not to do that, just given the rates of inflation that we talked about. They have to do something, even if it's just for optics. But I think the question for us, and this is a little bit of an unknown because you just don't have the data yet, is as you get into the fall, those rate hikes that are projected as you get into the fall, do those start to maybe come off the table? And does the Fed actually maybe become a little bit more dovish or a little bit more, think of it as lenient in terms of their policy? Because by that point, there's a very good chance that inflation is falling and maybe falling somewhat rapidly by that point. There's a possibility that, economic growth is starting to slow a little bit, that companies truly are starting to pull back. And the question for us that we've kind of debated internally is the Fed really data dependent or data driven? And if so, there's a decent, like I said, a decent chance that by the time you get into the fall months that they actually, again, if they're paying attention to the data, they may take their foot off the gas a little bit. Now, what we've seen historically would suggest that every now and then, maybe more often than not in some cases, they tend to hike us into that next recession, meaning that they just continue to hike rates until they've gone too far. And I think we would be in the camp that if they do complete all of those hikes out until next March, that very likely they will then need to cut rates sooner rather than later because they've probably created more of a headwind than the economy can handle.
Before you keep going there, I want to stop you there for a second. Because you're into the where are we going from here, and I do want to get to that. All right. And that's the R word that a number of clients and other financial advisors I speak to have brought up. I would like to get to that, but first, the interest rate hikes. You're mentioning them as part of slowing down inflation. I'm trying to think of an analogy to use about a patient being sick and the threat of making them putting them in worse shape, if you will, right, because of the care that you're providing. Right now, that's how I'll say it feels. It feels like the rapid increase in interest rates, the stock market is suffering because of it. Yet you're saying the ultimate intent is that it's sparing us from this extended period of inflation. Well, to put you on the spot, which one is worse? All right. Do we want that? So
no, I think that's absolutely fair. And I think this is how we would look at it is there is definitely the need for that inflation piece to be cooled. And I think that's what they're trying to do here and now from a Fed perspective. I think hindsight being 2020, probably the Fed wishes maybe they would have started cutting rates a little sooner in 2021. But remember where we were in 21, it wasn't entirely clear that we were even out of COVID at that point, or at least on the upswing, right? You had different variants popping up. So I think what they're trying to do right now is a little bit of catch up. And Lou, to your point, we all feel the pain from a market perspective as part of that. Again, I think that's something that the next, let's call it 2, 3, 4 months, are going to be volatile. They're going to continue to have some ups and downs and bigger swings. I mean, today the market's up big, tomorrow it's down big, whatever it may be. You're getting these wild swings, and that's probably here to stay for again a short to intermediate period of time. Now, over the longer term, that's where we can have a conversation about the R word. We can have a conversation about what drives markets higher from there. But you're going to have a period of volatility that's going to persist. And then it's a question of, as we get into the fall, which direction do we go from there?
Okay. And we will get to recession. I do want to just, you brought up the word normal market, or the words normal market a few minutes ago. I do want to touch on that for a moment, because we really have not and I've spoken with clients about this as we've reviewed portfolios. We have not been in what you would consider a normal market environment for some time. We've had artificially low interest rates driving the market increase. As you mentioned, we had an economy that someone pushed the button and it stopped, and now we're trying to crank it up again. Literally, if you could think of a hand crank, trying to get it going, it's a difficult thing to do. So it's taking some time. We haven't had a normal market environment recently. Are we entering what would be considered more of a normal market environment over the next, let's take it away from the months here, over an economic cycle, a few year cycle? Are we entering what could look like more of the normal market environment?
Yeah, I think you absolutely have that in the cards. I think, to your point, that's, once we get past kind of where we currently sit from an inflation, once that gets back to kind of where the Fed's wanting to get it under control, I think the idea of a normal market environment or a normal market cycle, where you go through periods of growth and then periods of decelerating growth or periods of recession, gets back to that environment. Again, that doesn't mean that markets always go up. Doesn't mean that markets always go down. Correct. But you have more of that normal cycle, as opposed, Lou, to kind of what you're hitting at is, at this point, for the last at least, it depends on how far you want to go back, but even the last 10, 12 years, at any given time, there's been specific nuances and special situations that have made things interesting, to say the least. No doubt. And I will just anecdotally, but actually factually as well, state that my interest rate in 1998 on my home was 8.5% when I purchased it. Okay. So you could go back that far if you'd like to, and say, now the complaint is there somewhere in the 4% range. Give me 4% every day, twice on Sunday, if you will. Absolutely.
All right. So where we're going from here, and you started to touch on it, and I apologize for pulling you back. But again, there's a lot for us to get through, and I appreciate that you're doing so. But you brought up recession. Let's start with the end and work back. Okay. A recession means what to the stock market? Yeah. So
technically, a recession has nothing to do with the stock market, right? Technically, a recession is just 2 consecutive quarters of falling economic growth, or the fact that economic growth is negative. So that is the technical definition of a recession. Obviously, that tends to accompany or be surrounded by falling market environment. So I would tell you, from our perspective, the possibility of recession is absolutely out there, but we don't think it's catastrophic recession. We don't think a 2008 recession scenario is really in the cards. If anything, we think we get kind of a short-term kind of technical recession, and what that means is 2 to 3 quarters of maybe slowing growth or falling, decelerating growth in that environment. But it's not one where it's 6, 7, 8 quarters consecutively. Because the reason we believe that is, if you actually look at both personal balance sheets and corporate balance sheets, folks are actually in a really good spot. in terms
Flush
of
with cash, I think is.
Yeah, you're flush with cash. You don't have folks that are levered to the hilt. Yes, we can have conversations about the housing market today, but the good news is that most of those purchases are not being made on second and third mortgages, right? Folks are maybe paying a little bit more than you and I look at and think would otherwise be reasonable, but they have the money to do it. And they're not taking on more debt. Lou, to your point, they're not paying exorbitant interest rates. So they have that benefit working behind them too. And it's the same thing on the corporate side. If you look at balance sheets, if you look at income statements, if you look at margins are at multi-decade highs at this point. You're not in an economic environment that you would expect to be in heading into a recession. And that strength, again, if you get even 2 or 3 quarters in a row of falling growth, at that point, we think you're in a strong enough position to get you out of it fairly quickly. I would say this, though, the other side of that is if the Fed does have enough, I would say self-control is maybe the word to use there, to back off that gas pedal a little bit. If they get inflation under control, maybe they don't go forward with all the rate hikes that are currently being discussed. If that's the case, that actually probably puts us in a pretty good spot as we get into the fall months, winter months, out into 2023. And in that scenario, the probability of recession is actually pretty low. So you've got this kind of which direction do we end up? If the Fed continues hiking, yes, maybe it pushes us into a recession in 23, probably the middle to late part of 23 by the time you actually enter that recession. But if they're willing to take their foot off the gas pedal a little bit, knowing that inflation is likely going to be coming down as you get into the fall months of 22, maybe we don't enter a recession.
Okay. So the answer to where are we going from here is it depends. So you've done an excellent job for the compliance team to say that you have made no specific prediction.
There you go.
However, I think you've given us 2 really good paths.
There you go.
Okay, that's fair enough. I mean, because of course it is looking forward. There's a prediction element to this. And certainly we want to stay out of that business. I think a good recent example of maybe wanting to stay out of excessive debt is the reports that Elon Musk is now kind of looking to pull out of that Twitter deal.
Reconsidering, right?
Reconsidering, yeah. So to wrap up, I do want to touch on bonds. I think they're misunderstood. We've talked about them so many times during our conversations, and I think they're so important. And again, just for a point of reference to clients and anyone that they share this with, and I have offered asked clients to share it with friends and family because I think this is such a valuable conversation. Bonds, you mentioned already, down 9% for the year. I have explained during conversations with clients that a lot of the drag that we're seeing on our portfolios is associated with those bonds, that we would potentially have less negative, than we have right now if we didn't own bonds. However, still an important asset class, especially as it applies to risk.
Yeah.
Are bonds no longer that hedge against the down stock market? And I do want to, again, point out that part of why I'm asking you this question is because of what happened in 2020 when COVID so rapidly drove the market down. Bonds performed terribly back then. I mean, it really had a once in a 100-year kind of event as it applied to bonds. So are they still a hedge against a volatile stock market, in your opinion?
Yeah, I mean, and to your point, the last 2 drawdowns, sizable drawdowns that we've had, have been unique from a bond perspective, right? The credit piece got hit really hard in 2020, and that made corporate bonds some of the worst performing asset classes, and for that matter, higher yielding bonds were right there by stocks. Fast forward to 2022. And it's not just corporate bonds, it's all bonds, right? It's treasury securities all the way to your highest yielding bonds. And that's more driven, right, by the interest rate hikes and the compressing of the Fed policy that we've seen. I don't know that I would go so far to say that, I would never use bonds again as a diversifier, because it depends on the environment in terms of what's driving market volatility. Right now, what is driving market volatility is the interest rate scenario that we're in, is the Fed policy surrounding the inflation piece, which has been driving interest rates, which is affecting bonds. Fast forward, say 12 to 18 months, and interest rates are, back to that 3% number, whereas is a little bit more of a long-term average, long-term normal. Say you get a market sell-off at that point, there's no reason where we sit today not to believe that they couldn't be a safe haven asset class in the future again. But I think what you're seeing right now is what's driving a lot of the market volatility, both equity and fixed income, is that interest rate side of the equation, which then makes bonds, Lou, to your point, in some cases as bad, some cases worse than the equity component, which is an environment, like you said, that we haven't seen in 30, 40, in some cases 50 years. So I won't say don't ever use them again, but where they sit right now, they're not nearly as beneficial from a diversifier standpoint as they would have been even 5 years ago.
Sure, but they are providing some kind of income to the portfolio,
Yep.
which of course could end up buying more depending on how the investor is handling it or how we're handling it with the client. Could buy more stock.
And I would say the one marginal positive, if you want to think of it that way, in terms of the fixed income, is rates are going up, meaning you're going to get more income off those bonds tomorrow than you did yesterday. So if the yield on your bond was 2%, a month ago, it may be 3% a month from now. So your point, that doesn't necessarily make things, perfect. Doesn't make them, doesn't make it back to par or back to even in terms of your total value of the portfolio. But it's a marginal positive. So you're getting higher yields, which is, like I said, is a benefit of, higher rates. So,
which gets into the specifics of each client. We have to have that conversation. Why do you own them? Why do you continue to own them? You brought up 30, 40, 50 years ago. It wasn't so long ago, but 1996, when I learned that important lesson that bonds can go down in value. And that was not a fun lesson then. It's not right now. However, again, reversion to the mean, time will be helpful. And you've heard me say it before, Austin. This time isn't different. It's just a different time. That's all. So we just our process, our methodology fits in. So fits into that thinking, that long range outlook. Short term it can be a challenge, but we put pieces in place that help us with that challenge. And with that, we can look to make sure that we keep a steady hand and a long-term outlook on things. So I have a couple of things that I'm going to ask you for a last word, but just before I do, there will be additional videos for everyone that's interested in those. Austin, again, and I have done these before. We'll be doing more through 2022 and other firms as well. Just for everyone watching now and later on, Alina Akram and Andrew Polzine have ended their internships. They had the longest run of internships ever at Tranquilli Financial Advisor, and they've done an outstanding job the whole way through. They both were phenomenal and have set the bar really high. My daughter, Sarah, will rejoin us for a period of time, which we're looking forward to that as well. And we have Mitch Fisher, who you may see his name on the screen here. He has joined us as the client service associate, and really thrilled to have him as part of the team now. And also, I just have to point it out before I give you the last word here, Austin, that I'll see if I can get this right. Here you go. That's Horace right there. Some very perceptive clients have noticed an addition to the desk behind me. Horus is the falcon. Well, it could be a god. It could just be the falcon that sits behind pharaohs in Egypt and either sees them off to the next world or watches over them while they're living. And I thought, wow, what a great what a great statue to have back from Egypt and include as part of this. So for those clients who picked Horace out in the background, well done. So with that, Austin, you can be our Falcon and tell us how you're going to watch over this moving forward.
Yeah, no, Lou, I think that's a great analogy. As we're looking out into the back half of 2020, I would tell you at Horizon, we're watching two things. Obviously, we're watching the Fed very closely to get a sense for, hey, are they going to hike us into a potential recession, or are they going to have that restraint that we talked about? So that's one thing we're watching. The second thing that we're watching, we didn't talk a ton about this, but this is something that I don't think can be overstated, is just the strength of the consumer. As we talked about, folks are flush with cash. You've got folks in really good kind of with their own personal balance sheets. And the question that we're watching, or the question that we've posed internally, is the consumer going to pick up the baton, if you will, that is being left off by the government in terms of a spending standpoint? We think they are absolutely able to do it in terms of, again, looking at the strength of their balance sheet. The question is going to be, are they willing to do it? I would tell you early data would suggest that they've started to get back out there post-COVID. You're finally seeing data that suggests that travel is getting back to some semblance of pre-COVID normal levels. You're seeing, the online purchases finally start to taper off, meaning that folks are actually re-engaging that service-based economy that we have here in the U.S. So those are the two questions: the Fed and the consumer figuring out or getting a better grasp, getting a better understanding of where both of those in the year, I think puts us in a good spot. Like we were talking about, there's absolutely a chance that we actually have a strong finish to the year. If you have the Fed showing that restraint, you have the consumer picking up the slack. There is, I will say, it's not out of the cards. It's not out of the realm of possibilities that we end the year positive from a market perspective. So
that is encouraging. Yep.
Yeah, I was going to say that we look at that and we're not all rainbows and butterflies by any stretch, but we also look at it, from a realistic perspective to say there's some possibility there for things to most definitely get better as we head into the back half of the year.
Well, I appreciate the rainbows and butterflies. Do not forget unicorns as well. Austin Fitch, Managing Director of Consulting Solutions, CFA, a Chartered Financial Analyst, correct? Analyst?
Yep.
And we appreciate your time. For all those, again, that have taken the time to be here live, thank you so much for doing so. Those watching after, please send emails, schedule a call if you'd like to have a personal discussion about what Austin and I are speaking about now. And well done, my friend. I always appreciate your time.
Absolutely. Thanks, Lou.
Thank you.